Hey everyone, it's Mike Kramer from Mott Capital. Today is uh, Thursday, November 30th at 8 o'clock New York time. So tomorrow we're going to have a pretty busy day. We're going to be getting ISM data tomorrow. We're looking for 47.8 versus 46.7. Prices paid is expected to rise to 45.9 versus 45.1. Employment expected to rise to 47.2 from 46.8, and new orders 46.7 from 45.5. Now, the other big thing tomorrow will be about an hour later, and that will be when Chair Powell will be speaking in a fireside chat at 11 o'clock in the morning, New York time. So, there's a lot of expectations here that this is obviously the last. He's the last person to speak going into the blackout period. We've seen him now do this on a few occasions. If we think back to the last blackout period, which came in the middle of October, and led into the November rate decision, which turned out to be a decision for the to not raise rates. But again, that came sometime in this period here, which really led to a pretty meaningful decline in the equity market. And I think that was because at the time, we saw Treasury rates really push higher towards the upper bound as the market sort of again began to price in that higher for longer mindset. You can see the 19th was somewhere right around this date, and then we saw rates kind of just hang out here for a while. And then after the Fed meeting, we started to see them come back down, and the refunding announcement from the Treasury. So, I don't think it's a given. I think the market has been pricing in a lot of rate cuts, certainly many more than what the Fed has projected at this point. Fed fund futures, for example, pricing at a Fed funds rate at the end of next year, 4.25%. Meanwhile, the Fed in September noted that it saw the Fed funds rate at 5.1% by the end of next year. So there's a really big difference there, nearly, I would call it 100 basis points difference, which is a sizable amount, obviously. And to be honest, yes, inflation has come down a little bit faster. The core PCE numbers today were pretty much in line or in line with expectations. We've seen a lot of volatility on the headline, and that's really been due to the changes in gasoline and oil prices. I mean, you get a month or two of gasoline and oil prices going up, and suddenly those headline inflation numbers don't look as nice. And so I think that's certainly something to consider. The other thing to consider, obviously, is that yes, the Fed will have to cut rates at some point. The question will be when, and the other question will be by how much. Because clearly, as the inflation rate comes down, the nominal rate, the nominal Fed funds rate, if it stays at 5.5%, and we have a 2% inflation rate, you'll have a real rate of 3.5%, which is just way too high for the economy to handle, and it would result in a very, very tight monetary policy. Likewise, right now we have a 5.5% funds rate, roughly, and we have an inflation rate, call it at 3%. So we have roughly a 2.5% real Fed funds rate. So if we were to see inflation go to that 2% target that the Fed is looking at, we would expect for the Fed to be able to maintain a 2.5% real rate. You would expect them to, of course, cut rates by a like amount. The question is the Fed going to have a 2% year-end target in 2024 for inflation? And that's really yet to be seen, right? And so that's just too far in the future for Powell to be signaling 100 basis points in rate cuts. I think at this point, he still has to lean to the side that if the economy doesn't cool or if they don't see enough slowing, and they see inflation kind of getting stuck in this 3 to 4% range, which I still think is quite possible given that we've had a lot of people leave the labor force since COVID started. 5 million people left the labor force. There was about 95 million people not in the labor force before COVID. Now there's about 100 million people not in the labor force. We've seen average hourly wages sort of flatline in this 4 to 4.5% range. And so as long as there's still wage pressure and we still have this absence of people that are working, I think that's going to keep inflation sort of a little bit elevated. So additionally, we're also been seeing, just to kind of throw in something a little bit different, the Baltic Dry Index, which has just really surged rather notably. Basically over the last couple of days, you can see up 12.7% yesterday. This is on a delay, but you get the picture. This has been rising rather dramatically, and this is because there's issues with the Panama Canal right now having low water levels. And this is another thing. Does this feed into, a possible rise in goods inflation at some point? Again, this is something that's broadly more happening. You are seeing freight rates go up, and we care about things like that because, again, if you see freight rates go up, another reason for Powell to kind of maybe keep the reins on things. And so, again, we talked last time about 10-year rates. 10-year rates continue to trend lower, although today we did have a reversal. Again, 10-year rates are sort of in this area where you would expect to find some support in this 4.25 to 4.30 region. Really, the big level here is now shaping up at this 4.35 area. Clearly, here's our big downtrend. We have the 10-year rate moving up close to it. We also know that the 4.35 area is certainly another area here that goes back to October of 22. So this certainly is an area where you would expect to see the 10-year rise. And if you were to get, a Powell that's more hawkish, more leaning towards more rate hikes, more hikes in general, or just leaving rates higher for longer, that could be a catalyst to pushing 10-year rates higher. And sort of looking at this just off the cuff, when you look at it and you kind of zoom out, you could almost, begin to make a case that this is, some sort of giant flag or pennant pattern forming. So I think it's worth keeping a really close eye on this 435 region over the next couple of days. Now, also the 2-year rate has been showing some signs of breaking down. You can see right now that we have the 200-day moving average in place. We're right now sitting on that. That I think is an important level. We've also reached the lower Bollinger Band, although we're not oversold yet, so we could still see this really kind of clip lower. It does look like the 2-year rate is sort of starting to roll over here, and you're starting to see something change. Now, again, this would be an area where you would expect the 2-year rate to probably get some sort of bounce and maybe even rise back to the 20-day moving average would seem like a reasonable spot for this to hold. Clearly, if the 200-day moving average breaks here, you're talking about, suddenly even lower than where we've been talking about. You're talking back into the 430s. And then we're talking about, a real situation where you're going to get a yield curve that's going to go positive. So this is something that we also need to be aware of because the yield curve is steepening, and yield curves are only going to stay inverted for so long. I mean, and when you look at this, right, you can see that the average yield curve inversion, at least going back to 1990, 595 days, 336 days, 546 days. And then when you come to today, you're getting to a point where, depending on where you want to start this inversion from, you're at 518 days. I mean, if you want to really go back to here, which I think is a bit of a stretch, you're talking already 602 days, which would be the longest inversion we've seen since 1990, right? And so I would think you started somewhere in this area. You're still approaching that point where, the odds favor the yield curve steepening at this point. And we can see that the yield curve started steepening well before it actually got out of negative territory in all three occasions. So it seems more likely than not at some point you are going to see the yield curve normalize, and that would mean that you have a 10, 30-year rate that's trading higher than a 2, which makes sense from a fundamental standpoint as well. So this is certainly something to watch. It also looks like, when you just look at this yield curve again, you would think that you would see something like, you have something here that looks sort of like a double bottoming process here with maybe your neckline in this region right here. So again, we're getting close to that point where you could see a pretty meaningful advance and perhaps even a normalization. And I would imagine this could happen with really the 2-year falling and the 10-year rising at this point, and then them somehow flip-flopping at some point in the not-too-distant future. Additionally, that sort of leaves us with the dollar. We saw the euro actually fall today, and yesterday we were talking about the euro and the 61.8% retracement level. I was saying it looked curious to see if that level was going to hold, and I had noted that we wanted to see if this was going to break out or not, and it looks like at this point, at least, it's failed to hold that level, and it looks like a rejection of a breakout. So again, we're going to want to watch to see if this area again continues to hold as resistance around this 61.8% retracement level, which is roughly 109.60. While I think you have support right now around 108. 108.69. Meanwhile, we also saw the British pound today down some, and again, similar sort of scenario. At this point, it seems like you're creating these zones where you have support around 126.23, and you have another sort of upper area around 127 and a quarter. When we swing over to the Nasdaq, you can see that the Nasdaq today actually came down and fell to this red trend line, which I think is significant because this is a trend line that goes back to the lows. So we're going to really want to watch to see how the Nasdaq trades today. So interestingly, today there was a $6.5 billion buy-in balance for the market on close, which is the final 10 minutes. It's the auction process in Europe. You have the auction process that takes place in the last 5 minutes, which I think is a much superior way of going about it. But in New York, they have what's called a market on close, and it's an imbalance. Basically, all the orders are held behind until 3:50, then they're displayed, and then at the close they print whatever they offset all of the imbalances, and that created this big sort of spike going into the end of the day. This looks these types of patterns, which some people I follow call it a wall into the close, and so typically when you see these type of patterns, it leads to a move lower the next morning. And it would be interesting to see, because if we gapped lower for some reason tomorrow and gap below this red trend line, I think that would be very significant, and it could signal that the rally is over at 15,845 or so. And I think that would set up for a gap fill at 15,514, because at this point, this looks like a rejection of a breakout attempt versus the July highs. And this is really interesting again, because we've had ample opportunity now to break out and move beyond the July highs, and the market hasn't been able to do that. Maybe it happens tomorrow. Again, you would want to see the index really kind of quickly gap higher tomorrow, actually, and take out this high. But just given the pattern here, it would suggest maybe a gap lower tomorrow. So I would keep an eye out for that. And certainly the Dow today was really aided by which had Salesforce, which had a great day, was up 9%, added 142 points to the Dow, and UNH was up 3%, adding 118 points to the Dow. So really, most of the move today was attributable to Salesforce. And again, the Dow actually was able to take out the July highs despite all of its troubles and all of the issues it's had in more recent times. It actually took out that high, and that leaves it just really below this all-time high right here around 36,905, which is about 1,000 points or so from an all-time high. And so again, many of the same dynamics here in the Dow with this big last-minute surge into the close. This is sort of a tricky close. I think this will be a tricky opening tomorrow, just given the size of the move that we saw at the close, and what typically, I would say is an indication that there's a good chance you gap lower tomorrow, or at least open and then have a sharp move down, which will leave open the possibility for this gap fill at 35,400 or so. And obviously the top upside resistance area would come, again back at this, old all-time high, and you'd have to go back to January of 22. You'd see that there'd be some resistance at 36,400 right around there. And then finally, if we just look at the S&P 500 today also had that big sort of last minute move higher. It was a pretty weak day overall. Again, similar sort of pattern there with maybe potentially a gap lower tomorrow. Again, I'm still thinking that this is some sort of negative wave count where we're entering actually what could be wave 1 down, wave 2 up. When we actually measure this out from top to bottom, you can see it's a nice 61.8% retracement level. So this would certainly be an area where this could mark a 2 and another wave down. So if we were to get a gap lower tomorrow, that would suggest maybe we're entering a third wave down, whether it be a 3 or a C. Either way, it looks like there might be another move here. And this is your support level here around 45.40. And then after that, you have to look for 45.10. Obviously, we move higher tomorrow. You need to take out 45.90. That's likely to be your next big level of resistance. Anyway, I hope you have a great weekend, and we'll see you next week. Bye.